Hey everyone, welcome back to Conviction Bet. Something different this time. We're going somewhere more fundamental. The question of why investors who already know the right answer still can't execute it when it counts. Here is a fact that should bother you more than it probably does. Peter Lynch ran one of the greatest investment funds in history for 13 years. 29.2% annually. $18 million into $14 billion. 2 best-selling books explaining exactly how he did it, in plain English, available at any airport bookstore. According to a widely reported Fidelity-attributed analysis, the average investor in his fund may have actually lost money. The market tells a story about information about who has better models, better research, better access to the right numbers at the right time. The real story is about something that has almost nothing to do with any of that. I'm J.L. Maurer, and this is Conviction Bet. We believe the stories that move your portfolio are usually quieter than the ones that move the tape. Here's where we're going. Today, I want to argue that most investors don't have an analysis problem, they have a hardware problem. That the gap between knowing the right answer and actually executing it is not bridged by more research, more data, or a better framework. And that the investors who have compounded serious wealth over decades share something that has very little to do with how smart they are. The most uncomfortable claim I'll make today: the smarter you are, the worse this problem might actually get. Let's start with the data. In 2024, the S&P 500 returned 25.02%. The average equity investor, 16.54%. That is a gap of 848 basis points, the second largest investor performance gap of the past decade. It was unusually large, but it was not a one-off phenomenon. Over the past 20 years, the average equity investor has trailed the index by about 1.1% annually. That sounds like a rounding error. On a $1 million portfolio, compounded over 20 years, that gap translates to roughly $1.3 million in lost ending wealth. Now, these are not investors who didn't know about index funds. These are not people unaware of the historical case for buying and holding. The information was freely available. The strategy was publicly documented. In many cases, it was sitting in their brokerage account, one click away from execution. Which brings me back to Lynch and Magellan. Lynch ran that fund from 1977 to 1990, 29.2% a year. He took it from $18 million to $14 billion. And then, in what I consider one of the most generous acts in the history of investing, he wrote the books, One Up on Wall Street, Beating the Street. He explained the philosophy clearly, accessibly, for anyone willing to sit down and read. According to a widely reported account attributed to Fidelity's own internal research, many of Lynch's investors dramatically underperformed the fund during this period. Some versions of the story say the average investor actually lost money, not underperformed, lost. On a 29% annual return fund, the mechanism wasn't mysterious. Investors piled in after strong years when the fund had already run. They fled after weak quarters when the fund was cheap. They bought high and sold low with such mechanical consistency that they managed to extract negative returns from one of the greatest investment records ever assembled. Lynch had given them the manual. They had read the manual, and they still couldn't do it. Think about what that is actually telling you. The failure was not analytical. It was not informational. These investors knew exactly what Lynch was doing and why it worked. The bottleneck was somewhere upstream from the analysis. Somewhere in the space between knowing the right answer and being able to execute it when the market is trying very hard to convince you otherwise. If your returns have trailed a simple index fund over the past 5 to 10 years, the honest question is not whether you need better stock picks. It is whether you need a better operating system. Now, let me give you a framework that I think actually explains what's happening. Think of an investor, really any person, as a computer. The body, the physical state, the baseline energy and health, that's the hardware. The emotional constitution, the willpower, the capacity to hold a position when it's painful, the ability to stay rational when the market is panicking, that's the operating system. And the knowledge, the investment thesis, the analytical frameworks, the spreadsheets, those are the software applications running on top. The framework sounds almost too simple, but it has a sharp edge to it. A crashed computer doesn't show you a blue screen. It keeps running. The interface looks completely normal. It keeps generating outputs. The only difference is that every output now serves a different master, not the pursuit of the correct answer. The minimization of present discomfort. And this is not a metaphor for something vague. There is a specific architecture behind it, both psychological and physiological. Let me start with the psychology. In 1979, Daniel Kahneman and Amos Tversky published what became one of the most cited papers in the history of economics. Their prospect theory demonstrated something that upended how we think about human decision-making under risk. It showed through controlled experiments that losses feel roughly twice as psychologically powerful as equivalent gains. Not a little more painful. Twice. Losing $1,000 is not the mirror image of gaining $1,000. It is qualitatively different and far more visceral. Kahneman received the Nobel Prize in Economics in 2002 inches part for this work. Think about what that means in a portfolio context. When you are sitting through a 30% drawdown, you are not experiencing something neutral. You are experiencing a psychological event roughly twice as intense as the pleasure you felt watching the portfolio go up by the same amount. The rational response, hold or add more, requires overriding an asymmetric emotional signal that evolution has spent tens of thousands of years making very loud. Now layer in the physiology. When you watch a position decline 30, 40, 50% over 18 months, your body produces cortisol, the stress hormone. What the research on chronic stress consistently shows is that sustained cortisol elevation impairs the prefrontal cortex, the part of your brain responsible for long-term planning, delayed gratification, and impulse control, while simultaneously increasing reactivity in the amygdala. The amygdala has exactly one operating principle: make the pain stop now. So the analytical brain doesn't shut down. It gets captured. And it begins generating increasingly sophisticated reasons why selling is actually the right move, why the thesis has fundamentally changed, why the macro environment is now different in ways you hadn't modeled, why patience is admirable in theory but imprudent in this specific case. And here is where it gets genuinely counterintuitive. Research on the sunk cost fallacy, the tendency to throw good money after bad in order to justify a prior loss, has found something that should make every intelligent investor uncomfortable. High cognitive ability does not protect against this bias. In some configurations, it appears to strengthen it. Think about what that means for a moment. The smarter you are, the more convincing the story your brain constructs. When your body wants to stop, the more airtight the rationalization sounds, the harder it becomes to recognize from inside the experience that what you are producing is not analysis. It is cortisol in the form of an argument. You see this pattern everywhere, once you know to look for it. The analyst who built a 500-line model to justify holding a position that any neutral observer would have cut a year ago. The fund manager who can articulate brilliantly, coherently exactly why this cycle is different, why the historical comparisons don't apply, why the valuation work still holds. The intelligence is real. The analysis is technically competent. But the conclusion was written by the amygdala, not the prefrontal cortex. Seth Klarman, who has run the Baupost Group since 1982 and built one of the most respected long-term track records in institutional investing, put it about as plainly as it can be put. He said, the ability to not be getting margin calls, not be having redemptions, not be scared out of your mind when something has gone against you is probably the most enhancing thing to long-term returns. Not the models, not the research, not the analytical edge. The ability to not be scared out of your mind. This is why brilliant people fail at investing in spectacular, perfectly reasoned ways. Intelligence is the tool. The operating system determines what it's used for. Let me take this to the historical record. Because financial history is essentially one long stress test of this exact thesis. Let's start in 1939. World War II has just broken out in Europe. Markets are reeling from a decade of depression. 34 companies on the New York Stock Exchange are already in bankruptcy. A 27-year-old investor named John Templeton calls his broker and gives him an instruction: buy 100 shares of every single stock on the NYSE trading under $1 a share. Every one, including the ones already in bankruptcy. He bought into 104 companies. He borrowed money to do it. By the time American industry had geared up for the war and he sold the holdings 4 years later, he had, in figures often cited at the time, turned roughly $10,000 into approximately $40,000. Only 4 of the 104 companies turned out to be worthless. Templeton later described his investment philosophy in a single sentence: the time of maximum pessimism is the best time to buy. He said this not as an abstraction, but as a description of something he had done with borrowed money in the middle of a world war when 34 of the companies he was buying were already in bankruptcy proceedings. The analytical case for that trade required no genius. The stomach for it required something else entirely. Warren Buffett. The 17th of October, 2008. The S&P 500 is down roughly 40% from its October 2007 peak. Lehman Brothers filed for bankruptcy about a month earlier. Money market funds had broken the buck. There was genuine, credible discussion about whether the global financial system would survive. Buffett published an op-ed in the New York Times, the title, "Buy American, I Am." His timing was, in the short run, terrible. The index fell roughly another quarter before bottoming on the 9th of March, 2009. And then from that bottom, the price index rose about 2.7 times by end of 2013. Total return nearly tripled. The analytical case for buying in October 2008 was available to anyone who could read a balance sheet and had studied prior market recoveries. What wasn't available to most investors was the physical capacity to act on that analysis, while every signal in the nervous system was screaming that the world was ending. Buffett didn't have better information. He had a better operating system. Charlie Munger, 1973 to 1974. His partnership compounded at 19.8% annually from 1962 to 1975 against roughly 5% for the Dow over the same period. The path included a 53% cumulative drawdown over those 2 years. About 32% down in 1973, 31% in 1974. Blue chip stamps representing 61% of the entire portfolio at year-end 1,974. Munger later described those years as what he called the tortures of hell. Some investors grew deeply uncomfortable with the losses and sold, locking in permanent damage that those who stayed never suffered. The investors who held made fortunes. Munger was not smarter at the bottom than he was at the top. He was harder. Howard Marks. Between early 2007 and May 2008, Oaktree raised what was at the time the largest distressed debt fund ever assembled, $10.9 billion. And they sat on it deliberately for over a year, waiting for conditions to get worse before deploying. The fund began investing in May 2008, well before Lehman failed, and then accelerated sharply. In the 15 weeks after Lehman, Oaktree deployed approximately $5.3 billion. Marx's client memo from October 2008 stated the posture in 8 words: will the world end or won't it? They were investing on the assumption it would go on. The decision required no new analysis. It required the operational fortitude to move while everyone around them was paralyzed. Michael Burry. Starting in 2005, Burry bought credit default swaps against subprime mortgage bonds through his fund, Scion Capital. For nearly 2 years, almost 24 months, the position bled premium payments and produced nothing but mark-to-market losses. Investors sent hostile letters, demanded redemptions, threatened legal action. Burry restricted withdrawals to keep the trade alive. When the subprime market broke in 2007, the thesis returned $725 million to his investors and roughly $100 million personally to Burry. He was not smarter than the Goldman traders he bought those swaps from. He was more capable physically, psychologically of enduring 2 years of being told by the markets and by his own investors that he was wrong. Now, the counter case, long-term capital management. Founded by John Meriwether of Salomon Brothers, with 2 Nobel laureates in economics on the roster, Merton and Scholes, who had won the Nobel the previous year for their work on options pricing. The fund's first 4 years, roughly 21%, 43%, 41%, 17%, extraordinary returns, driven by models that identified tiny pricing discrepancies and amplified them with enormous leverage. At the start of 1998, LTCM held roughly $4.7 billion in equity, $129 billion in on-balance sheet assets, and approximately $1.25 trillion in derivative notional exposure. As losses eroded that equity across the year, effective leverage exceeded 250 to 1. Their models treated what happened to them in August 1998 as extraordinarily unlikely, the kind of event the math said should not occur. When Russia defaulted on its sovereign debt, the fund lost approximately $4.6 billion during 1998 and required a $3.65 billion private sector bailout coordinated by the Federal Reserve Bank of New York to prevent the crisis from spreading. 2 Nobel laureates, the most sophisticated quantitative risk models money could assemble, and the most convincing possible rationalization for accepting leverage that would eventually destroy them. Dryly, the Federal Reserve had to make some calls. 5 cases on one side, 1 on the other. The pattern is the same across all of them. Analysis was equally available to everyone in the room. The differentiator was the capacity to hold under extreme pressure, or in LTCM's case, the inability to recognize that their own intelligence had become the instrument of their destruction. Now, I want to tell you a story, and I want you to hold it in mind through the rest of this episode because it is the clearest illustration I've found of exactly what we've been describing. In the 8th century, when the Umayyad Caliphate fell and the Abbasid dynasty moved to eliminate what remained of the old ruling family, 2 princes fled together, swimming a river to escape. According to later accounts, halfway across, a soldier on the bank called out that the new caliph had issued pardons. They could return, live comfortably. They posed no real threat. One prince turned back. He was killed. The other, Abd al-Rahman, swam to the far shore, made his way to the Iberian Peninsula, and eventually founded what became the Emirate of Cordoba. His dynasty ruled for nearly 3 centuries. The prince who turned back was not stupid. He understood exactly why he was running. The logic of the pardon that surrender was safer than the physical exhaustion of continuing to swim was not irrational on its face. You could build a reasonable argument for it. What happened was simpler and more human than any argument. Halfway across a cold river, under physical duress, his body gave his brain a new assignment. The question changed from, will I survive this in the long run, to how do I make this stop right now? And his intelligence went to work on the second question, and it found a very satisfying answer. That is the mechanism. The investors who sold out of the Magellan Fund at a fraction of its eventual value were not uninformed. They were halfway across a cold river. Their bodies flooded with cortisol, amygdala running hot, loss aversion, screaming at twice the volume of any rational signal, found a way to make turning back sound not just reasonable, but wise. Peter Lynch said it better than I can. The key organ in investing is not the brain. It's the stomach. So, what does this actually mean for how you should live and invest? It means improving your investment outcomes requires working on something that has nothing obvious to do with investing. Kobe Bryant was widely reported to follow extreme early morning training routines beginning at 4 in the morning, deliberately pushing through the point at which his body told him to stop. The skill being built over thousands of training sessions was not a shooting technique. It was the hardwired understanding that discomfort is not a stop signal, it is a continue signal. The psychological skill being trained is directly analogous to what you need to hold a position through a 40% drawdown and not sell. Ray Dalio has practiced transcendental meditation for 20 minutes twice a day since the late 1960s, years before Bridgewater existed. He describes it not as relaxation, but as a tool for what he calls equanimity under chaos. The Oak Tree deployment in 2008 was not a moment of inspired courage. It was the output of an operating system that Marx had been maintaining deliberately and systematically for decades before that moment arrived. The question is not whether you know the right answer when markets are calm. Every serious investor does. The question is whether you have built the hardware to execute it when they aren't. Now, I want to be honest about the limits of what I've argued, because intellectual honesty here is the difference between a useful framework and a dangerous one. The bear case on this entire thesis is survivorship bias. We hear about Buffett and Templeton acting at moments of maximum pessimism, not about the investors who also held the wrong companies and never recovered. We hear about Burry enduring 2 years of hostile investors, not about the short sellers who had the same conviction, ran out of capital before the thesis paid, and were wiped out. Fortitude without a valid thesis is not patience. It is stubborn bag holding. And there is no shortage of retail investors who have convinced themselves they are being disciplined when they are actually just wrong. That is a legitimate concern. And it is specifically why this framework is not hold everything always forever. It is define what would cause you to sell before you are under duress, before the position is underwater, before the cortisol is running. Pre-commitment is what separates discipline from stubbornness. And without it, the same fortitude that makes the great investors great can make the average investor a very patient loser. So here's what I think you should actually do. First, pre-commit when you're calm. Oaktree had raised the $10.9 billion fund before the crisis deepened. The post-Lehman deployment was the execution of a pre-built plan, not an improvised bet made under fire. Marx had decided years earlier exactly under what conditions that capital would be deployed. The execution was mechanical. Your version. Before you buy anything, write down what would cause you to sell. Not vaguely, specifically, what data point, what timeline, what threshold. Sign it. When the position is down 40% and you find yourself building a new airtight case for why the situation has fundamentally changed, go read what you wrote when you were calm. Second, track your own behavior gap. Once a year, calculate your actual return against a simple index fund. If you're trailing by more than 1% a year consistently, the problem is almost certainly not your stock selection. It is the timing of your buys and sells. That is an operating system problem. More research will not fix it. Third, recognize rationalization by its sophistication. The sunk cost trap does not reliably weaken with intelligence, and in some cases, research suggests it may actually strengthen. If you find yourself constructing an unusually airtight, unusually comprehensive argument for why a position you've held through 2 years of losses is actually fine, treat the sophistication of that argument as a warning signal. The more compelling it sounds, the more carefully you should ask, am I analyzing this, or am I generating cortisol in the form of a thesis? Fourth, size for the stomach you have, not the stomach you want. Munger said it directly. If losses are going to make you miserable, and some will, you might be wise to adopt a conservative investment pattern for your entire life. A strategy you can actually hold through a real drawdown is worth more than an optimal strategy you panic out of at exactly the wrong moment. Every time. And fifth, maintain the hardware. Physical conditioning, sleep, the daily practice of doing something difficult before you feel like doing it. Exercise can meaningfully improve executive function, the same function that chronic stress degrades. Sleep deprivation measurably impairs cognitive control and impulse regulation. These are not lifestyle recommendations, they are operating system maintenance. Treat them accordingly. Let me come back to the river one more time. Abd al-Rahman swam to the far shore. He was not more informed than his brother about what awaited him there. He had no superior intelligence about whether the pardon was genuine. What he had and what his brother, halfway across, physically exhausted and losing aversion, burning at full volume, could not hold on to was the capacity to keep going when everything in his body was telling him to stop. Markets manufacture that moment regularly. Every serious drawdown is a river. Every compelling rationalization for selling is a soldier on the bank promising a pardon. The behavior gap is not an analysis problem. It never was. The investors who close it are not the ones who read more, model more, or research more intensively. They are the ones who have built deliberately over time the operating system to execute what they already know at exactly the moment when it is most uncomfortable to do so. And that is work that begins nowhere near a Bloomberg terminal. It begins in the unglamorous business of building a body and a mind that doesn't fold when things get hard. The morning you exercise when you don't want to. The position you hold when everyone around you is selling. The decision you pre-committed to in writing months earlier that now feels suffocating and that you execute anyway because you understood something back then that your cortisol-flooded brain is trying to argue you out of right now. The river is always there. The soldier on the bank is always offering a pardon. Every investor has an opinion about which prince they are. Very few have actually tested it. Pause. Anyway, that's this time. If you prefer to read, the show has a Substack called Quiet Velocity. Find it at quietvelocity1.substack.com. That's quietvelocity, the number 1.substack.com. And if you're enjoying Conviction Bet, subscribe wherever you get your podcasts, Apple, Spotify, YouTube, Amazon, whatever you use. Leave a review if you have 30 seconds. It genuinely helps new listeners find the show. Until next time, stay patient, stay skeptical, and keep your eye on the quiet stuff. I'm J.L. Maurer. This has been Conviction Bets.